Ever wonder how the super rich seem to pay so little in taxes? It's not magic, it's strategy. Today, we're pulling back the curtain on 15 clever ways wealthy individuals legally reduce their tax burden. This video is for anyone curious about tax laws and financial planning, offering insights into methods that go beyond the average taxpayer's knowledge. From complex financial instruments to strategic deductions, the wealthy employ a variety of sophisticated techniques. Understanding these methods can demystify the tax system and provide valuable knowledge for your own financial journey. First up, capital gains tax loopholes. The rich often benefit from preferential tax rates on long-term capital gains, significantly lower than ordinary income tax rates. They also use strategies like, quote, tax loss harvesting to offset gains. Next, offshore accounts and tax havens. By legally structuring assets in countries with low or no taxes, the wealthy can shield a significant portion of their income and wealth from domestic taxation. This isn't illegal, but requires careful legal planning. Charitable deductions and foundations are powerful tools. By setting up private foundations or making large charitable donations, the wealthy can receive substantial tax deductions, while also retaining control over how their money is used for philanthropy. Real estate depreciation allows owners to deduct a portion of their property's value each year, even if the property is appreciating in value. This creates a, quote, paper loss that can significantly reduce taxable income from other sources. Deferring income strategies allow the wealthy to push income into future tax years, when they anticipate being in a lower tax bracket, or simply to delay the tax obligation, thereby increasing their current cash flow. Using trusts to minimize estate tax is a common strategy. By transferring assets into various types of trusts, the wealthy can reduce the taxable value of their estate, ensuring more wealth passes to their heirs without heavy taxation. Stock options and deferred compensation are prevalent in executive compensation. Instead of immediate cash, executives receive stock options or deferred pay, which are taxed at a later date, often at lower rates, or allow for strategic timing of income. Business expenses and write-offs are extensive for the wealthy, who often own multiple businesses. Everything from travel to home office costs can be legitimately deducted, reducing their overall taxable income. Like-kind exchanges, specifically 1031 exchanges, allow investors to defer capital gains taxes when they sell an investment property if they reinvest the proceeds into a similar property within a specific time frame. This allows continuous wealth building without immediate tax hits. The carried interest loophole primarily benefits hedge fund managers and private equity investors. A significant portion of their compensation, often called carried interest, is taxed at the lower capital gains rate rather than as ordinary income, even though it's essentially their pay for managing money. Municipal bonds offer tax-exempt interest. Wealthy investors often flock to these bonds because the interest earned is free from federal income tax, and sometimes state and local taxes, making them a very attractive low-risk investment for tax-conscious individuals. Qualified opportunity zones provide tax incentives for investors who reinvest capital gains into economically distressed communities. This can defer, reduce, or even eliminate capital gains taxes for long-term investments in these zones. Gifting and inheritance strategies involve carefully planned transfers of wealth to heirs over time, often utilizing annual gift tax exclusions or lifetime exemptions to reduce the taxable value of an estate upon death. Number 14 involves using complex debt structures. Wealthy individuals might take out loans against their assets rather than selling them, avoiding immediate capital gains taxes while still accessing liquidity. And finally, number 15, specialized deductions for certain professions or investments. From oil and gas depletion allowances to specific agricultural deductions, the tax code has carve-outs that disproportionately benefit those in certain industries or with specific types of investments. These are just some of the ways the wealthy navigate the tax landscape. Understanding these strategies isn't about promoting avoidance, but about recognizing the complexities of the tax system and empowering yourself with knowledge. Always consult a qualified financial advisor for personalized tax planning. Since you've stuck around till the end of this video, it's clear that you found this topic intriguing, and I think you'll definitely want to check out the videos popping up on your screen now. They explore even more fascinating topics in finance that might just challenge your perspective. And if you enjoyed this video, make sure to like and subscribe for more videos that break down complex and foundational topics in finance. Thanks for watching.